Good morning and welcome to Market Monday for November 10th, 2025. Well, we officially have begun the longest shutdown in history, at least at the time of this writing, going on now for 38 days. Oddly enough, the last shutdown right here in 2018 going into 2019 was the second longest shutdown. Are these two latest shutdowns anomalies or the start of a trend? Probably the current state of politics more than anything else. Of course, next we got estimates of the economic cost of the government shutdown. Some say 10 billion a week, some say 15 up to 30 billion a week in lost GDP economic growth. This could end up lowering fourth quarter GDP by up to 2 percentage points. As we've been talking about lately, the AI spending boom has largely been carrying GDP over the past few quarters. So this reduction could drag GDP negative for the fourth quarter. And while government shutdowns historically don't cause calamity, and our base case is that things are going to be more or less resolved back to normal, we are in uncharted waters here, so we're going to keep an eye on this. Something else that we're keeping an eye on are layoff announcements. Here's 2025, and so far, just through the third quarter, we're already at the highest level since, yes, the bottom of the global financial crisis. Okay, fine, here's COVID, but we're considering that an anomaly. And look at the prior past 2 years. 2 consecutive years with the highest layoff announcements since the global financial crisis. This is why we think it's likely that we'll get another rate cut at the Fed's mid-December meeting. Add a couple red days in the stock market to this and you get, you guessed it, extreme fear in the market. It was only a few days ago that the flagship US stock markets, the S&P 500, the small cap Russell 2000, the Dow Jones Industrial Average, and the NASDAQ 100 all closed at new monthly all-time highs. But to be fair, 2025 has been a bit of an outlier with such extreme bearishness despite strength in the stock market. Here, we're looking at the number of bulls versus bears. The lower the gold diamond, the more bears. And the blue bars is the performance of the S&P 500 stock market. See, in the past, investors were much more bullish. Look at the dot-com crash. And despite 3 years in a row of negative stock market performance, investors were still bullish each of those years, and remained so even as the market rebounded. This is going back to 1987, and you can see there are only a handful of years where bears outnumber the bulls, half of them in the last 5 years alone. And just a quick glance shows that investors have never been so wrong-sidedly bearish, meaning being bearish when the market is so bullish, in the history of tracking this. And something else to keep in mind. Here's what usually happens in a post-election year, like we're in right now. Over the past 10 years, the S&P 500 stock market has done quite well in post-election years. Here's the same data going back to 1950. The clear trend since 1950, and even more so in the past 10 years, is that next year, the midterm year, is the weakest. Again, 2018, 2022, and now 2026. So we'll see. But again, this is looking at the stock market on a month's or a few years time frame. As I said last week, we would encourage you as stock market investors to zoom way out, as that's where you're going to get your biggest benefit of stock market investing. These are fairly arbitrary time periods, essentially each 25-year period going back a long time. Was the stock market really even remotely the same thing in 1900 as it is today? Even 1950, we might argue. But we have 3 25-year periods since 1950. And perhaps surprisingly, the most recent period has been the weakest. Of course, the stock market doesn't move in a straight line. Case in point, the first decade of this period ended with the S&P 500 stock market down almost 10%. With the last 15 years doing the heavy lifting. Have a great week.